Hello and welcome to day 17 of the 30-day money course. Today we are answering the question, what is the stock market? I'm Elizabeth Bukor and I am the founder of Wealth from Little. I'm also your hostess here on the 30-day money course. Okay, to answer this question, I am going to share with you a little story of what used to happen in the past hundreds of years ago and what happens now, in the hope that this will really explain to you what the stock market is. So in the past, when merchants used to trade all over the world, and I'm talking like 400, 500 years ago, when merchants used to trade all over the world, they would load these huge merchant ships with gold or spices or material, fabric, and they would have to do these huge long voyages across the world to trade and make money. However, they started experiencing financial challenges. They knew these journeys will be successful, but they needed capital, they needed upfront support, financial support. And so they started approaching private people and asking them that they knew could support them financially and asking them for this financial support in exchange for a share in the profits in the future once these journeys, these voyages were over. And it turned out very profitable for both parties, the private investors and the merchants as well. They were able to make more money because they were able to have the capital to go to even more places to trade and trade their products and goods with a lot more people. Now, before we fast forward to today, I just want to talk to you about the power of words. We know that words give power and they also disempower based on the words that we say. So saying something like, oh, the stock market is so hard to understand versus it's easy to understand how to invest in the stock market. Both are very, give you different types of power. One is quite disempowering and one is actually empowering. So I want you to watch the kind of words that you say about yourself or that you think in your mind with regards to investing as we start this. I want you to start thinking things like, I can understand this. It's easy for me to understand this. It's easy for me to invest. As your words change, you will notice that your vocabulary starts to increase in the direction that your words are changing. So if your words are changing to in a more positive direction, you will start to increase your vocabulary positively in that direction. So I want you to pay attention to the rest of the story and pay attention in particularly to the words that I use. Okay, so let's fast forward to today. So that's how business was run in the past. And, the merchants had to have this, needed money for these big ships. But now, let's say I don't want to have, I don't need a big ship anymore, but I have this business idea. Maybe it's a new tea company, it's a new coffee company, it's a new service type of company, it's a new technology kind of company. It could be a product, anything. I have this idea and I believe that a lot of people all over the world will profit from it. However, I don't have enough money. So I registered my company, I registered this idea and I registered my company, and now I am a private company. I'm selling in my community, in my area, but I want to go further. And so I can now decide to introduce my idea and advertise it more of to people I feel have the money to back me financially, right? And these are my private investors. So I share my idea with these big private investors. And if they like the idea, they think it's a great idea, or they think it's a profitable idea, they can now decide to be my first big investors, right? And they can also decide to sponsor my company's initial public offering. Now, this is called IPO. Once that happens, I am now a publicly traded company. Remember, I said I was registered as a private company, but now I'm a publicly traded company. I'm a PLC. Once I'm now in the public market, I will be listed on the stock market. The stock market is literally a market where all the companies that are publicly traded are listed. And what that means is that people can now come, the public, no longer just private select few, the public can come and decide to buy a piece of my company. So when I was private, those big investors decided to buy a piece of my company as they decided to invest some money in exchange for profit in the future, which is, having a share in the company's profits forever. And now that I'm now in the public, I can now sell a piece of my company to the whole public. The private people help me raise some money, but with the public, I can even raise much more. And I don't have to do anything in return except for promise the shareholders, the public, a piece of my company. So if they buy one share, they will get a profit equivalent of that one share of the company. So now that I'm on the stock market, millions of people, everyone in the public, literally you, me, my brother, my sister, your cousin, your neighbor, we have access to investing. If you think that my idea is a good idea, you can also invest in my idea. So if you think my business could be profitable, you can also invest in my business. So now everyone has an opportunity to come to this stock market and buy a piece of my company, buy a piece of my company in exchange for a share in the future. So every time my company makes profit, or your share of my company will also make profit. And so you are making money as I am making money. And it works both ways. It's beneficial for you because you didn't have to do anything. You just have to you just invested your money and now you are making profit because my company is profitable. And on the other side, for me, I'm able to raise capital easily without really going to the bank, applying for a loan, getting a credit card. I'm able to raise easy capital, right? And so that's the benefit. So what happens is that as my company, as people start investing in my company, the interest, people start talking about it. And so interest starts to grow, right? As interest grows, the demand for those stock also increases. And as the demand for those stock increases, the price of those stocks, which is a little piece of my company, so the price of those stocks increase. As the price of those stocks increase, the market value of my overall company starts to rise. And so the people who already are invested in my company, the value of their share grows, of their stocks grows. And for the people who are just investing, they invest at a higher price, but then it will continue to grow, hopefully, as it can, as the demand continues to increase. So this increased interest, this increased growth will help me increase my funds so that I can create more types of products, be more innovative in my company. And it's amazing. But however, there's also the possibility that the company may be less profitable than I think, right? And so the reverse can happen. So, and what that happens is like people can decide that actually, I don't think this company is as profitable as I thought it would be. And so therefore the demand starts to reduce. As the demand reduces and when supply is high and demand is low, you know what that means? That means the price of each share, each stock starts to reduce, starts to drop. So each stock price starts to drop, and if it drops so low, it can cause a crash. And as it falls, this means that my company's market value will also fall. And anyone who's invested will have big losses, right? Unless, of course, which always happens, that the company might again in the future become profitable again. So if those investors stayed invested, then they can make their profit back again. Now, so this is all a huge, roller coaster of supply versus demand, and how and the stock price really just follows. If the demand is high, the share price goes up. Once the demand goes low, the share price comes down. And then that's what makes share prices fluctuate so rapidly. Now, this fluctuation is not just caused by, people just deciding I want to sell. Sometimes it's caused by, changes in, the way technology is. So if a business used to use a certain type of technology and technology quickly changes and they don't adapt, that can cause, that can cause them to lose market value. It can be due to changes in cost of labor. We do need human labor. We do need to pay for that. For, in companies do need to invest in labor. So it could be because of changes in the cost of labor. It could be because of changes in governmental leadership, changes in legislation in countries. It could be because of bad publicity. Maybe someone, the CEO could have released a tweet that made people fearful, that could trigger it. It could be because of, issues in the economy, like a pandemic, that could trigger investors being worried. And once investors are worried about anything from laws to natural disasters to anything, what investors would do is they want to cut their losses. So they would start to sell their shares and their stocks in the company. Once they start selling, other people might get wind that, oh, this person is selling. So they think that could be something worrisome. So they decide to sell as well. And the more people sell, this is what causes a particular company's stock to nosedive per se. So the stock market and the share price is highly dependent on human confidence and also appearance. If the company appears to be doing well, generally it will eventually do well because people see the outward appearance and say, ooh, that company is doing well. They tell their friend, they tell their neighbor, and everyone rushes in and buys more and buys more. And that pushes the share price up. So more people come in and they buy at the higher price, pushes the share price even higher. And more people come in and keep buying at the higher price, and it keeps pushing the share price higher. So and the share price keeps going higher because more people are having more confidence in that company, and that's why they're putting more money in it. And so it's really dependent on appearance. And if the company appears to be losing value, for example, you see something on the news and you think that the company might lose value, just the appearance of losing value can make people lose confidence in the company. And once confidence is lost, people start to sell, and it can cause the stock crash. And doesn't just happen to one company. When this happens to multiple companies at the same time, it can lead to a market crash or a huge market crash. And so you can see that the stock market is very volatile because it's highly dependent on the emotions of many people. However, that's why investing for the long term, if you are going to invest in the stock market, investing for the long term is the best strategy when you're investing in the stock market, because you can ride out those ups and downs of human emotion, right? And keep keep getting profitable returns year on year. However, if you are trying to invest for the short term, you're hoping to pick a company and invest now, take your returns in a couple of days, because you need to just grow your money really quickly. If you're trying to use it as a get rich quick scheme per se, you need to have a lot of education and a lot of information to help you with that, because human emotion is hard to predict. So you need to know exactly what you're doing. And I don't particularly encourage getting, get rich quick schemes, right? Or manipulating any system to get rich quick. Okay, so we're going to pause there and we'll see you in day 18. So for today, your assignment again is to increase your financial vocabulary. I've shared with you some words here and I've kind of explained what they mean. But there are some words I have said that I may not have explained. And you might be thinking, oh, but what does that mean? So I want you to increase your financial vocabulary today. I will end there. Email me done once you are done, and I will see you tomorrow in day 18. Bye.